Hello. What's going on, YouTube world, Facebook world, Patreon world, Twitch world, Twitter world, everyone? I have returned today with some more ADH Wealth Solutions and some reality checks. Today, I want to talk to you all about paying for college, using your life insurance policy, and the difference of that versus something like a Section 529 college savings plan. Most of the time, my lives are going to be quick, fast, and in a hurry because I touch the topic and then I kind of bounce out. So with that being said, I want to get started. Let me go ahead and turn off this music and show you some things. All right, so if I'm going to get started, we're going to show here, and I'm going to show you my screen. Let's share my screen. Now, you're going to see my entire screen because I'm going to be bouncing back and forth from window to window. Okay, let me go ahead. Here, obviously, you can see my screen. Now, the first thing I want to show you here is what a Section 529 college savings plan is. So, as you see here, since people don't like to trust licensed advisors, and there are places there for you to go, it's Investopedia. So, it says, what is a 529 college savings plan? A 529 plan is a tax-advantaged savings plan designed to help pay for education. Originally limited to post-secondary education costs, it was expanded to cover K through 12 education in 2017 and apprenticeships programs last year in 2019. Two major types of plans are prepaid and what most people know is the savings plan. Okay, prepaid meaning if I'm wealthy and I want my kid to go to college, I just drop the whatever many thousands it is to pay for college, and then that money stays there. Most people are going to put in a little bit of money over time to pay. So as it says, prepaid tuition plans allow the account owner to pay in advance for tuition at designated colleges and universities, locking in the cost at today's rates. 529 plans are also referred to as qualified tuition programs and Section 529 plans. Some of the key takeaways of those 529 plans are that they are tax-advantaged accounts and that they can be used to cover educational expenses from kindergarten through graduate school. Again, there are two basic types, the saving and the prepaid. And then certain states do actually offer a Section 529 college savings plan. Now, if you look here, okay, it shows us the average total cost of attendance for a first-time, full-time undergraduate student. Now, most students are not going to a public school, which is around $20,000. If you look at all across all year boards from 2010, most recently to 2018, it's a little over $22,000. When you go to private for-profit colleges, you'll see here the prices spiked up. The average in 2018 was about $33,000 per semester. This is not, for all 4 years. And if you look here, on average, private nonprofit colleges are on about a $52,000 a year since 2018 annual tuition. Now, this does not include your Ivy League schools like Yale, which is about damn near $100,000 a year. Okay, now, there are some negatives to a Section 529 plan. Let's go a little further here, see if this will go ahead and break it down for you. Okay, so it says understanding 529 plans. Although 529 plans take their name from a Section 529 of the federal tax code, the plans themselves are administered by the 50 states and DC. So anyone can open a 529, but they're typically established by the parents, grandparents, godparents of a child or a grandchild who is in the end the beneficiary. Now, in some states, the person who funds the account may actually be eligible for some tax deductions. The money in the account does grow on a tax deferred basis until it is withdrawn, as long as the money is used for qualified education expenses. So you have to use this for one of those purposes that I said earlier, which is what? K through 12 or grad school, or undergrad school, or now you can actually use it for an apprenticeship program, which is cool because they used to not be able to do that. And you would have your money locked in here. So as it says, the money in the account grows on a tax deferred basis until it is withdrawn, as long as the money is used for qualified education services. Those withdrawals aren't subject to either state or federal taxes. In the case of K through 12 students, tax-free withdrawals are limited to $10,000 per year, which is messed up because most K through 12s that are private schools are $14,000 a year. Okay. And I'm continuing here. Okay. As it says, there's no limits to how much you can contribute to your 529 each year, but many states put a cap on how much you contribute to it in total. The limits generally range from 235 to a little over $500,000. Again, $500,000 would be 4 years in Yale. So the savings plan is the most common type, where you contribute the money over time. It's selected into, or it's divvied into a different amount of mutual funds. You can kind of choose the funds you want to invest in, but most of the time you don't. And then they're also going to be, they're limited into what you can really do with them. Okay. We're not going to go to the prepaid tuition plans because most people aren't able to prepay for college. Okay, so tax advantages of a Section 529. So the earnings in a 529 plan are exempt from federal and state income taxes, provided the money is used for those qualified educational expenses. Any other withdrawals are subject to taxes plus a 10% penalty, with the exception of certain circumstances such as death or disability. So basically, your Section 529 college savings plan can also be a life insurance policy. But here's another cool thing. Your life insurance policy can be your Section 529 college savings plan. So today I'm going to show you that. So let's create an illustration. I'm going to use a different client. Let's use this woman, Rosa, because this is another. Actually, I'll create a new client. Let's do November, because today is November. November college kid. Hopefully this is large enough for you guys to see. You know what? I'm going to increase the screen because I'm looking at it on StreamYard and it doesn't look large enough for me. Okay. We're just going to say this kid's in Connecticut. We're going to say that this kid was born on February 4th, let's say 2010. So they're 10 years old now. Okay. And actually, what's today's date? We'll do today, November college student. So we'll do 11/22/2020. Well, no, let's not say that this child is born 2020 because you can't get life insurance on a person who's under 15 days old. So let's say they were born 1 year ago. They're currently 1 year old. Okay. November college student. Age 1. Insurance age 1. So we're going to do a standard insurance. Actually, I'm going to do a indexed. Oh yeah, these are some of the different types of life insurance policies you'll have available. As in, I don't want to do an annuity. Let's do a 10-pay. Okay, so a 10-pay means that you're only paying this policy for 10 years. Okay, so again, this is a kid. Let's say they want a $100,000 face amount policy. And we're not going to do paid up additions because we want to take your dividends and we want the dividend paid in cash. Actually, no, I'm going to leave the dividend to accumulate at interest. Now, you know what? We'll leave it at paid up additions. I don't want to change stuff too much right now because I want to make it as simple as possible. So let's say you're getting a $100,000 policy for this kid, right? Now, if we preview here, this is a whole life policy, by the way. The only way you're going to build money is in whole life policies. You'll never build money in a term policy. So this is a policy you're only paying for 10 years. Okay, and it's not about the death benefit, even though this face amount is $100K. Right? Now, Again, your kid is looking to go to school. So you're paying how much? $76. Is this a month? For 10 years. Okay. For $100,000, right? So you're paying $918 a year. So over the course of 10 years, because you're only paying this policy for 10 years, you've paid $9,185. Let me see if I can increase the size of this so you can actually see that. Okay. So again, $76.54 is how much you are paying for the, here we go. How much you are paying for the policy. And then you are looking at the cash value accumulation. So let's look here. Remember, there's a dividend. I mean, we like dividends, right? Everybody likes to talk about dividends. Life insurance company that pays dividends. If you'll notice here, your death benefit increased by $10 because the company gave you a $10 dividend, and you only have $10 of cash value. Again, it takes some time for your cash value to actually accumulate. Usually the first 5 years, you don't have much cash value accumulated. But again, let's look at the premium outlay. So you've paid $9,185. Okay. Now, at this point, at the end of 10 years, your cash value, which means your cash surrender value, is $8,520. So technically, you did not pay $9,000. You paid about $600 because the cash value there, if you subtract 8520 from 9185, you've actually only paid $600 for this life insurance policy. Now, as we move forward, wait, you're not paying anymore because it's only a 10 pay. So as we're going, you haven't paid a dime in after year 10, year 11, they're coming, and wait, they're 12 years old, year 11 in the policy, and you haven't paid in anything else. You stopped paying at $9,185, and now your kid is 13. And your kid at the age of 13 has $9,454 worth of cash value available at their hands. Wait, but you only paid $9,185. So this life insurance company just paid you almost $300 to have life insurance on your kid. Now your kid is 21. He has $13,645 available to him. And this is paying less than $100 a month on a life insurance policy. And this is the importance of paying at least $100 or more a month to your child's life insurance policy. The ill part is that this grows at a larger compound interest rate than even the bank accounts. You see, a bank account grows at an interest rate of 0.0. So actually, you know what? I'm not going to get too deep into that. I'm going to save that for another video. So, but as you can see here, by the time your kid is 21, so between 18 and 21, we're looking at college age. Now, again, this is, you put away $9,000. Your kid, in the course of a couple of years, right there, let's see, policy year, what is this? They're 19, so let's say policy year 17, they're 18 years old, and they have $12,023, right? Now, on the flip side, if you put that money in the bank, they wouldn't have $12,023 because the bank grows at 0.075% APR. So for every year you keep $100 in the bank, you earn 75 cents. For every month you put $100 in this life insurance policy, you earn $2. It's kind of a no-brainer. So this was a really brief explanation. I just wanted to go over again a little bit of differences between a Section 529 and again, a life insurance that you can use as a Section 529. So then the ill part is, God forbid this child gets sick or injured. If they get sick or injured, there's something in this life insurance policy called living benefits. So what will happen here, I'm going to go up to it, is this. This child, let's say, gets sick or injured. Right? So, you know, in year 1, they get sick or injured, the first year of the policy, and they have a critical illness, right? They can access $25,000 of that policy to help with that critical illness. That chronic illness would be $50,000, and that terminal illness would be $100,000 because you got to leave at least $25,000 in the policy. Now let's look at what a critical illness would be. A critical illness would be an open heart surgery, an angioplasty, or myocardial infarction. So life-threatening cancer, stroke, or a major transplant, or like kidney failure. A chronic illness would be the inability to perform 2 or 6 of the activities of daily living. So let's say your kid gets hit by a car and they're a vegetable. They can't dress themselves or go to the bathroom alone. Well, you can access that $50,000 in that chronic illness rider. And let's say, God forbid, your kid gets, something and it says, oh, they're going to die within a year. Well, you can actually go ahead and access $75,000 and have that kid have a great time with their life before they die. Now, you can't do any of this with a Section 529 college savings plan, number one. Number two, show me where you can only put $100 into a Section 529 college savings plan. Generally, those you need to start with a lump sum of about $5,000. Whereas a life insurance policy, you start with the application. You don't even have to pay $1 to apply for life insurance. But if you're going for those other financial products, you'd better come to me, a licensed life insurance agent, with a check. Whereas this policy is free $99 for you to sit with me. It's free $99 for you to learn. It's free $99 for you to apply for. And until you get it, you don't pay a dime. So guys, that's going to be my short video for today. I'm going to post many more of these as we go. I think that they're valuable. I think that you all will learn a lot from this. And like I said, this is a 10-pay whole life. So when it comes to whole life insurance, there are many, many, many different options. When you have term life insurance, like many other agents from other companies may tell you, buy term and invest the rest, because apparently there's no benefits to cash value life insurance. I just showed that to be absolutely untrue when you can use this cash value life insurance policy from a child as young as 1 year old and actually pay for their college, versus paying that person who sells you the term policy 2% of your net worth to have that Section 529 college savings plan, because there are additional fees that come along with that financial product. There are 0 fees on a life insurance policy. It's the best, most robust way to pass tax-free dollars, and you can use it for multiple purposes. Where investments and things like 529 college savings plans, you have to use for the purpose they are, or you have to liquidate them, meaning that it's difficult to actually get that liquidity and get access to that physical cash. So with that being said, everyone, I'm going to go ahead and stop sharing my screen for now. What's good, Kareem Austin? What's good, Sheed? I'm glad to see y'all here. I didn't even see y'all was in here for a minute. I was just going over this information. So if y'all are still here and y'all feel like asking some questions, please do. I will definitely answer any questions in the chat. I'm going to go ahead and mute myself for a moment and wait for any questions. Okay, so I currently don't see any questions. That's fine. Like I said, I'm going to try and make these shorter videos so that I can go ahead and teach everyone. Anyone, if you get any benefit from this, please like, comment, subscribe, share. Again, the hope is that the more each one teach one. My goal is to teach y'all this. Obviously, I want you to come do business with me as a salesperson. I'm never going to turn away business, but I really want more financially savvy, especially Black people, because that's who I do it for. I speak from the angle of who I am and what I am unapologetically. Other communities, you're definitely welcome to do work with me, but my major goal is to definitely help the African American community with their financial planning, estate planning, all of that good stuff. So again, this was just a brief live to show everyone some of the benefit of a Section 529 college savings plan, where you can actually pay for college with your life insurance policy, as opposed to paying all those fees in the Section 529. With that being said, I'm going to go ahead and end this. With that being said, peace, Black power, Black lives matter, one love. I'm out.
Our goal is to break the power of the mob in America, and nothing short of it. We mean to end their profits, imprison their members, and cripple their organizations. cripple their organization. Cripple their organization.